Imagine you emerged blinking from your bunker in the wake of this: interest rates up to 4%, the value of the pound down more than a quarter, unemployment up almost 10%, residential property prices down by a third, commercial real estate prices down by two-fifths, world and UK GDP down 2.4% and 4.7% respectively. How many UK banks would you expect still to be standing? The answer, if the latest round of stress tests carried out by the Bank of England are anything to go by, is all of them, or at least all those that were tested. Written off as almost uninvestable by much of the market, none of the listed UK banks failed the annual test of their financial resilience. This test is a kind of balance sheet wargaming that also takes virtual lumps out of their investments. Thus, in the latest scenario, the bank's balance sheets were expected to cope with the FTSE 100 and the oil price plummeting respectively 45% and 52% in a year, and the foreign exchange and bond markets similarly hit. In terms of imposing stress, the regulator wasn't holding back. And, as we mentioned, all the UK banks passed. The stress tests the UK banks have just faced is almost twice as bad as 2008 and 2009 combined. In the spirit of complete openness, Barclays and Royal Bank of Scotland (RBS) should perhaps have an asterisk by their names, as they would not have passed based on the strength of their balance sheets at the end of December last year, which was when this round of stress testing officially started. Get a weekly roundup of the best value perspective posts. Nevertheless, if you take into consideration the remedial actions those two banks have taken since, the capital generation and the disposals made, then the UK banking sector boasts a 100% pass rate. All of them were judged to have enough capital on their balance sheets to withstand what was on paper, as it were, a pretty apocalyptic set of circumstances. Banking share bears. Should you be one of the legion of banking bears? Of course, you might argue it is not possible to model such complex and dynamic systems on a spreadsheet. The world is a more complex place than that, and the Bank of England, in common with everyone else, has no idea what will happen in the future. And we would completely agree with all those points. But we would also point out the cumulative effect of the stress tests the UK banks have just faced is almost twice as bad as 2008 and 2009 combined. Over those 2 years, which sat at the heart of the financial crisis, the UK banking sector lost a total of £28.6 billion at the pre-tax profit level, whereas the stress test they have just been through envisaged them losing £48.7 billion in aggregate. Whether you take the stress tests detail by detail or as a whole, therefore, the banks passed. Time to look at banks again. In recent years, Barclays, Royal Bank of Scotland and Standard Chartered have all had to take some kind of action to shore up their finances, but these latest results are arguably the cue for Standard Chartered to start paying a dividend again. RBS too, once it sorts out its litigation issues with the US Department of Justice. It is, in other words, the green light for the UK's banking system to return to normality, and yet, as a sector, the banks are valued at 0.8x price to book, that is, as being worth 80% of their assets minus their liabilities. As such, we cannot help but feel anyone who now chooses to disagree with the Bank of England's verdict, continuing to avoid banks on the basis their balance sheets are too weak, are now really just looking for excuses. Kevin Murphy is an author on The Value Perspective, a blog about value investing. It is a long-term investing approach which focuses on exploiting swings in stock market sentiment, targeting companies which are valued at less than their true worth and waiting for a correction. Important information. The views and opinions contained herein are those of Kevin Murphy, fund manager, and may not necessarily represent views expressed or reflected in other Schroders communications, strategies or funds. The sectors and securities shown above are for illustrative purposes only and are not to be considered a recommendation to buy or sell. This material is intended to be for information purposes only and is not intended as promotional material in any respect. The material is not intended as an offer or solicitation for the purchase or sale of any financial instrument. The material is not intended to provide and should not be relied on for accounting, legal or tax advice, or investment recommendations. Reliance should not be placed on the views and information in this document when taking individual investment and/or strategic decisions. Past performance is not a guide to future performance and may not be repeated. The value of investments and the income from them may go down as well as up, and investors may not get back the amounts originally invested. All investments involve risks, including the risk of possible loss of principal. Information herein is believed to be reliable, but Schroders does not warrant its completeness or accuracy. Reliance should not be placed on the views and information in this document when taking individual investment and/or strategic decisions. The opinions in this document include some forecasted views. We believe we are basing our expectations and beliefs on reasonable assumptions within the bounds of what we currently know. However, there is no guarantee that any forecasts or opinions will be realized. These views and opinions may change. Issued by Schroeder Investment Management Limited, 31 Gresham Street, London EC2V, 7QA. Registration number 1,893,220 England. Authorized and regulated by the Financial Conduct Authority.